Hey everybody, Economic Ninja here. I hope you're doing great. I'm doing great. I want to talk to you about the bond market today and it being on shaky ground. And we're going to give a specific instance of one thing that's putting stress on the bond market. But first, let me say, if you guys haven't subscribed or if you don't mind looking down to see if you have been unsubscribed, it is quite staggering how many people have been unsubscribed. And if you have, please do me a favor and put it in the comment section below. You know that ever since I came up with the dollar whippet theory in June, I talked about how we're going to move through 3 different cycles. If you haven't seen that video, I'll try and post that here, repost it pretty soon, or not repost it, but I'll tag it. But I've been talking about an event that I believe is coming, and guys, I'm not a financial advisor, just a dude with a bro hawk and a dream, trying to warn people to be prepared, right? To be prepared for these coming events. Why you're prepared? Not to survive, but I want you guys to thrive. I want you guys to be prepared for the next downturn in the economic cycle, and I believe that is a currency collapse, which is going to be 100% tied to the bond market. And the bond market, you could see throughout the last week, news stories about the bond market is showing very serious signs of stress and worry. Okay, the bond market is the biggest market. The bond market is the big whale, the big gorilla in the room. Okay, so when we talk about bonds, I want you to understand that bonds are tied to everybody's pension, insurance policies, all kinds of stuff. It is the big kahuna. All right, here we go. This is one stressor that's happening in the bond market right now, and I can't say bond market enough. All right, this is out of Yahoo Finance. I'm gonna set the link in the description below. Senior living facility defaults in the Muni market break a record. It says senior living facility defaults in the municipal bond market are at a record high, and the distress won't likely end soon. It says here the persistence of the events that have been going on the last year is driving up labor costs, and a federal mandate to vaccinate all healthcare workers may amplify an already serious worker shortage. So right now there's a hard, it's very difficult to get people set up to keep working, if you know what I mean. Meanwhile, occupancy at an independent assisted living facilities hasn't bounced back from record lows, even as the rates increase and the facilities end move-in moratoriums. I apologize. It says after about 1.6 billion of the Muni bonds issued for senior living facilities have defaulted this year, representing about 4.3% of the sector's 37.6 billion of defaults as of January 1, according to municipal markets analysts. 31% of borrowers have missed a debt payment for the first time, tying the full record set for 2020. So let's stop there. So it says right here, 31% of borrowers have missed a debt payment for the first time, tying that percentage for the full year record that was set in 2020. So last year, there was a record set in the amount of defaults for assisted living care facilities, right? For their bond payments. That was a record. What they're saying is as of this much of 2021, we have now matched that, which means it's going to be worse. Now, even if 1.6 billion in defaults in the bond market isn't big, obviously, in the grand scheme of things, but what happens is every time there's more defaults in a different sector, and there's defaults over in this sector in the bond market, then this part of the bond market, there's defaults, and they start to grow, what happens is traders get very anxious, and eventually they will demand a higher rate of return for the debt that they're putting out there, okay? And that strains the bond market. And it makes it very difficult for central banks and for governments to lend and borrow, because their stress is pushing that pressure to put that interest higher. I believe that you're going to see a day in the near future where the bond market it collapses, and we're going to see the Federal Reserve actually lose control of the interest rates. And they're going to try and spin it some different way. Very similar to what happened in 1980, late 70s, 1980. Paul Volcker was hailed as a hero for spiking interest rates. What they don't want to tell you on the news is what it did to asset prices. It absolutely collapsed the real estate market because the mortgage rates screamed up. Credit cards screamed up. The facts of the matter is the bond market is collapsing. It is a slow death. and the pressure is out there. And by the time it hits the news, it's usually too late. Now, when I say too late, it's in front of now the mainstream. But really, we know how the news cycle moves. So to start to explain to you, that the bond market is starting to collapse right now, it's not like it's going to happen tomorrow or the next day, okay? But it will, like, when you go back and it happened, like in 2008, it will almost seem like it was overnight. It was a shock to the average person. So in the end, what are there some things that we can do? Well, we need to understand our exposure to some of these asset classes. Are you heavyweight bonds? Is this the time to go and talk to a financial professional and say, hey, am I heavy overweight in bonds? Should I move into a different asset class or diversify more? That's the most important part, is diversification. Because nobody has a crystal ball and can tell you what day and what hour, what asset class is going to collapse first. But just being diversified is going to take care of a myriad of those issues. All right, guys, I hope you got something out of this. Keep looking into the bond market as this develops. Take a look at the article, because I already said something that I probably shouldn't have said, because they will do some interesting stuff around here. So thanks again, guys. Like and subscribe. I really appreciate it. The Economic Ninja is out.